Wall Street is trying to recover from one of its worst days all year. Well, let's take a look at where the markets are going. Amy Kong is the Chief Investment Officer at Barrett Asset Management. Thank you for joining us. So, listen, September is living up to its reputation as being one of the worst months of the year. But the reasons behind the fall, inflation, rising bond yields, slower growth, China, all of those things are still with us. So, what is your game plan for the fourth quarter?
Yes. Hi, Conway. Thanks for having me. I start off by saying that history often doesn't repeat itself, but it really often rhymes. And so some of the things that you've mentioned, some of the risks that you've mentioned, we've seen it before. Markets have also been weaker because they're reacting to a change, a potential change in quantitative easing program. The Fed has signaled that, and that change can materialize as soon as November. And we are in agreement with the Fed's reassessment of how much liquidity they want in the system. And so, with all that said, we think that again, the policy is accurate, and that we will stay with the playbook of really riding out this storm. And so we're not making any major changes to our client portfolios at this time, although there are certain pockets of the market that we may be paying more attention to going forward. I would also add that the pullback that we have seen thus far, the largest drawdown that we've seen in 2021 has been in the mid single digits, maybe 5% plus or minus. And that, in our opinion, is still a very healthy pullback. Looking back to history, going back to the 1980s up until today, the average drawdown can be somewhere between 14 and 15%. So just wanted to put that into context in terms of what kind of market pullback we're having thus far, and why we're still, again, riding out the storm and staying in the stock market for the rest of the year and into 2022.
There's a lot of political wrangling right now between the Democrats and the Republicans. What is the risk from what's happening in DC to the overall market outlook?
Yes, you're absolutely right. There is a lot going on in Congress right now, with the debt ceiling being top of that laundry list, to a number of things going on to financing this infrastructure bill, potential changes to the estate and tax rules, many things on this list. Looking back to how the markets have reacted to government shutdowns, and quite frankly, there have been a number of them since the 1980s, 14 to be exact, since 1980. The market reaction has been, on average, muted. Given government shutdowns, I think the average drawdown the week before a shutdown is roughly around 2%, maybe 3%. And so from that standpoint, it's comforting to know that the markets try to look past the fact that the government may shut down, and it probably will try to find a resolution. I think the bigger risk is when we start to get confirmation of potentially what the tax rules are. I know that right now the numbers are being thrown around that it could be somewhere between 25, 26, 27%. And the markets are adjusting for that higher tax rate to a degree, but I don't think it's fully baked in yet. So when we get closer to the point of whether it's 26 and a half or 27%, I think the market will start to adjust earnings for 2022 and onwards to better match what the Congress is saying. And so right now, I think the markets are thinking that it could be somewhere around 25%. It may be higher. And so ultimately, it may take a couple of dollars off from where 2022 estimates are, and it doesn't really derail the system, but it certainly will add to volatility as we get more and more confirmation of what those numbers look like.
Finally, let's talk strategy. A lot of investment strategists over the past few months have been talking about the barbell approach, the barbell approach, the barbell approach. Are you now leaning more towards one side of the other, or one side of the other, growth, value?
It's a great question. And, for us, it's not necessarily growth versus value. We have both in our portfolios, and we'll always have that growth tilt in our portfolios. I think in an environment like this, where inflation is moving higher, it could stay for longer, and it probably won't go back to below 2% for a while. Investment preference may be leaning more towards shorter duration cash flow versus longer term, meaning investors may prefer cash in hand dividend payers, companies that have very strong buyback programs and the like. And so our approach in more recent days has been thinking about the universe out there, and really trying to strike that balance between growth, which we still think is super important, especially as taxes are going higher, input costs are going higher, labor shortages are making wages go higher. We think companies need growth in order to offset some of those higher expenses. But at the same time, again, given the inflationary concerns, we're trying to find companies that can actually handle both sides of the equation, meaning growth companies that can also be consistent dividend payers, and can also, again, contribute to buyback programs. So we're not necessarily leaning towards deep value per se, but we're really trying to find companies that, again, can strike the balance between still staying on the growth course, but also handling present day issues such as making sure investors are happy and growing dividend yields. And we're not finding that in any particular sector, by the way. We're actually finding these business models everywhere. And to us, dividend yields, I think, has always been important, but I think in an inflationary environment, it becomes a lot more important.
Thank you. That was Amy Kong, Chief Investment Officer at Barrett Asset Management. I'm Conway G. Gittins, and this is Reuters.